On February 12th, CMHC dropped massive changes to their MLI Select program, and almost nobody is talking about it. If you're a developer or a real estate investor in Canada, you absolutely need to pay attention because these changes will directly impact your bottom line. This wasn't just a minor tweak. This was a complete overhaul of how apartment construction financing works in Canada, and driven by international banking standards and new federal regulations. So whether you're breaking ground on new builds or renovating existing properties, the game has completely changed. Today, we're breaking down 5 critical elements you need to understand: why this happened, what's it going to cost you, the turnover trap that could kill your cash flow, the new red tape you'll face, and the tougher requirements for earning discounts. Let's get to it. Let's start by examining why your insurance premiums just experienced a massive increase. The story actually begins with international banking regulations known as Basel III. Imagine these as worldwide safety protocols for financial institutions. Their purpose is to guarantee that banking organizations maintain adequate capital reserves if economic conditions deteriorate. Can't imagine that happening. Canada's federal oversight body, the Office of Superintendent of Financial Institutions, or OSFI for short, leveraged these regulations to revise our domestic key framework called MICAT, which is short for the Mortgage Insurer Capital Adequacy Test. According to the updated MICAT regulations, financing for large apartment complexes, particularly those involving minimal down payments, are now classified as an elevated risk. To maintain system stability, the government is now legally obligated to maintain substantially large capital reserves for these lending products. Since they have to set aside considerably more funds now, CMHC is transferring this expense to the borrowers through increased insurance premiums. So in essence, the international banking standards have just raised the entry price for everybody. What a surprise. Beyond the financial implications, the 2026 revision introduces substantially more documentation and red tape. Wow, what another surprise, more red tape. Compulsory bonding. Unless your development contains less than 24 units, CMHC now typically mandates a surety bond or a 10% letter of credit. So this is going to guarantee the project completion. Even if you're serving as your own general contractor, you still have to demonstrate that you've secured this protection. Another one is universal appraisals. Every single development now, regardless of the size, requires a comprehensive professional appraisal report completed within the previous 12 months. And there's no other approaches that are accepted anymore. Then there's the double stress test. When evaluating your debt servicing capacity, CMHC is testing you at whichever is greater, the prevailing market interest rate or your actual contractual rate. This confirms that you can continue to service the mortgage if interest rates climb. And then there's the environmental hard stop. You cannot receive any loan disbursements until your property site receives a 100% confirmation of that it's environmentally clean completely. And progress remediation during construction is no longer permitted. And there's the point system. For securing discounts, the point system for securing discounts has also become more challenging, let's say. CMHC now utilizes the 2020 National Building Codes as the baseline standard. So a property that qualified as highly efficient 2 years ago might now just rank as average. So to earn those substantial energy efficiency points, your building has to perform 40 to 70% superior to the most recent and most demanding building codes. Additionally, if your energy performance and accessibility documentation isn't submission ready at the moment of application, they will reject your application outright. There's no more placeholder submissions allowed. Now we're getting to the changes with the most financial implications. the ones that are going to directly hit your wallet. So the 2026 revision established two separate insurance pricing structures depending on your project category. For ground up construction or new construction, if you're developing a new apartment complex and the financing exceeds 90% of the total cost, your baseline insurance premium now sits at about 7%. And this represents your initial rate before applying any discounts. For a value add or renovation project, if you're acquiring an existing property for rehabilitation, what CMHC designates as all other loan purposes, the baseline premium is a little bit lower. For financing that covers 90% of the property's value, you're facing a base rate of 5.9%. If the financing is more than 90%, the rate increases to 6.15%. But renovations now face a new obstacle, the effective gross income surcharge. If the property hasn't achieved full occupancy at your projected rental rates when you require funding disbursement, you're going to get an additional 0.25% penalty. This makes stabilizing the older properties more costly than before because the government wants evidence of a completed revenue-generating asset before they're going to fully reduce their risk exposure. The second big change represents a serious concern for your future revenue potential. We're calling it the turnover trap. When you accept a discount for providing affordable units, you have to comply with stringent rent limitations for 10 or 20 years. We already knew about that. That was part of the program. But before, when an affordable unit tenant moved out, certain property owners would increase the rent substantially up to the maximum table rent permitted by CMHC for that area. The February 26 regulations don't allow that practice anymore. So when the existing tenant moves out, you're only allowed to increase the rent by whatever the consumer price index states. So for 2026, these caps are extremely restrictive. In Alberta, for example, the ceiling is 1.3%. In Newfoundland, it's even tighter at 0.6%. So even when the CMHC table indicates you could charge $1,700 for that unit, if your departing tenant was only paying $1,300, your incoming tenant is restricted to only about $1,317. So you're essentially confined to minimum growth throughout your entire commitment period, whether that's 10 or 20 years, and you cannot reset to the maximum table rate on turnover. So to recap, international banking regulations have driven insurance costs upwards, and the turnover trap constrains your future rent revenue. The MLI Select program now demands significantly more strategic planning, superior construction standards, and more comprehensive upfront documentation. If you're currently mid-build or mid-renovation, these changes may directly affect you. Get in touch with your lender or mortgage broker right away and find out what your next steps need to be. If you're thinking about starting a new project, stop and run your analysis again using these updated rules. Be ultra conservative with your numbers and protect your capital.